Okay, let's keep the market conversation going with our first guest for the hour. We've got Tony Dwyer, a Canaccord Genuity Chief Market Strategist. Tony, good to talk to you today. The market certainly expectation has moved in the direction of another 75 basis point rate hike from the Fed today. Are we expecting any surprises? And if so, how do you think the market responds?
Well, I'll tell you what, the last time they basically said what was expected, and it ended up with a surprise anyway. Honestly, if you gave me if you gave me the news right now, I'm not sure how to trade it. It's not oversold enough to say that, everything on a negative side is discounted, but clearly they're still raising rates, and that's not a great news item for the economy either.
Tony, Ness here, and one could argue that the Fed wants asset prices to come down, all sorts of assets, including the stock market as well. And it has been a relatively orderly decline. If you think about it, right now we're looking at the S&P that's down year to date about 18%. But investors want to know, are the markets going lower? If the Fed continues on this path, 75 basis points, let's say today, then another rate hike in November and December, then are we going to see further declines? And if so, by how much?
Well, Ines, I think it's a really important point. A month ago, after the summer rally, when people were saying that the market is likely discounted a recession, I thought that there was no way that was true. So you fast forward and, you take, for example, Federal Express, which was down about 36% from its peak in 2021 into their pre-announcement, and then it gapped down another 25%. U.S. Steel, Aluminum Company of America, Nucor, all these companies have pre-announced difficult earnings going forward in a difficult environment. So now you're beginning to price it in. So I think it's going to be a lot more average stock based, but I also can't find a time to answer the question directly. I can't find a time where the market made, quote unquote, the low while the Fed was still raising rates pretty aggressively.
So how do you play the market right now? Do you buy into it, or do you kind of put things on hold, especially with the big question in the market about where inflation moves from here?
Well, Kiko, what I've been doing this year is I've been standing aside. I don't think it's a great time. At this point, you're down 20% from peak without a knowledge of what the recession is going to actually look like. So the idea that now you should get negative, I think, is a mistake. Or now you should get excessively defensive, I think, is a mistake. That trade has already been put on, and the valuations of the defensive areas and the outperformance has already been pretty extreme. So what you want, to me, what I'm doing is for the more active traders, what I've been saying, I'd like to be light and tight, meaning I'd like to be as hugging the benchmark where I can without a lot of excess exposure. And on the long only, the longer duration investors, it's just a waiting, hugging the benchmark until you can actually look to get more aggressive. So our call this year coming into the year was that it was going to be a tumultuous year on a monetary transition in the first half and an economic transition from, quote unquote, buying stuff to doing stuff. And I think that's played out. Then we got the summer rally, and we've been anticipating what I've called a fall. And I think we're in the midst of that fall, which means what's the next thing? And I think what it's going to be is a more sustainable bounce on the back of a Fed pivot, because the economy, in our view, is going to get pretty nasty, which is the only thing, either a market event or a really tough economy is the only thing that'll make the Fed really pivot.
And that was my next question. When do you see the Fed pivoting? Will it be the markets going lower by X percentage points? Will it be unemployment going higher? What is going to make the Fed cry uncle?
That's a perfect question, Ines. It's unemployment going higher. I think fundamentally, of course, we're looking at inflation. That's been the focus of everybody. But that's also the past focus. I think the most important focus economically now is going to be the unemployment rate. Remember, the Fed has a dual mandate. And unfortunately, they've been in a box all year because it works both work with a lag. But as the unemployment rate goes up, and as you can see in the chart in 2020 that's up on the screen, and also in any prior recession, it goes up very quickly. And nobody's thinking right before it starts to go up, okay, this is going to go up very quickly. They think it'll be a nice, moderate move. It's not the way it works. So with the monetary tightening, with the financial conditions tightening, I think the most important thing to look for in the next few months is going to be a higher unemployment rate, which will allow the Fed to pivot.
Okay, some direction there as we wait for that Fed decision at 2 o'clock this afternoon. Tony Dwyer, as always, good to have you on. Canaccord Genuity Chief Market Strategist.